More now about that and more with Jeremy Siegel, professor of finance at the Wharton School at the University of Pennsylvania, also chief economist for WisdomTree. Professor, great to have you on. And I know those historical stats don't mean squat. They don't mean anything. They don't guarantee anything. But if you're an investor or even a gambling person, you got to kind of like those numbers.
Right. Right. If the roulette spin is red 4 times in a row, it doesn't mean it's going to be red the next time. But I think that a 90-90 day is significant. I don't think we're going to be 20% higher, but 5 to 10% higher within the next 6 months certainly seems like in the realm of possibility. I mean, I think this bull market is certainly still intact. Earnings revisions are still upward. And finally, as you know, I've been calling for lower short-term rates. I believe that Fed funds rate should be in the low 3s, should be 100 basis points below the 10-year. I think it is heading down there, and I think that's a great comfort to investors.
Yeah, were you surprised by just how powerful the market move was on Friday?
Yeah, I mean, when you have such breadth and such power, both in growth and the value. I know Russell was up big because it's the small stocks that are certainly looking for the short-term rate to go down. But it really shows you that this was not a tentative rally. I know there's a little bit of backup now on the Dow, but when you have such a big gain and you hold most of it on the following Monday, especially in a seasonably weak time as we have now, I still think that that's a signal that this rally isn't over.
Does the volume, though, or I should say lack of, Friday aside, Friday we just talked about the huge volume. The rest of last week, it's August, it's the summer, volume has been terrible, Professor. Today, I'm sure the volume numbers won't be great. Does that matter in how we should think about the market?
Well, again, late in August, we've had wonderful weather here on the East Coast, up and down. People are saying, hey, finally beach time. They do their trades in the morning when the announcements are out, and then they go to the beach. The afternoons are really dead in the market, and second half of August, given that circumstance, I think is not unusual. So I'm not worried about the lack of volume. Certainly, in the afternoons, and again in a seasonably weak period, as we know, last half of August and first half of September. If you can show strength, even if you can just maintain where you are in that period of time, that's usually a good omen for the rest of the year.
Yeah, what's the risk, though? There's always a risk to the market. We've given the bull case, a lot of historical stuff, a lot of money coming into this market. By the way, the U.S. markets are actually some of the worst performing in the world this year. Almost every market in Europe, which I think except for France, is better than us this year. But what is the bigger risk to the macro market?
Well, first of all, one reason, of course, the foreign markets are doing better is the dollar's down. I mean, they've gained on their own to be, but when you have a 10% fall in the dollar, that adds 10% to Americans' foreign returns that we have there. But when I look at the risk, I say no follow through by Jay Powell. I found September 7th, he said, hey, I'm looking at the data, and, I've decided against it, or we've decided as FOMC against it. I think that puts an end to the rally. Now, I think on Friday we're going to get that PCE. I think that's going to be a good one. Despite that upside surprise that we had in the producer price index, I think we're going to have a quite online, or maybe even a tenth lower on one of the month-to-month. But I think we're going to be online in the PCE.
Huh.
Yeah. And now,
so Professor, but